Silver just slipped through a level analysts said would hold into next year. It didn't break with a crash or a headline. It broke with silence. Volume surged, bids thinned, and within hours, the market behaved as if a floor had vanished. When a price drops and the response is muted, that's not indecision. That's acceptance. And it marks the opening chapter of a timeline that points directly at 2026. The first anomaly shows up when silver is placed beside gold. On long-term charts, gold remains compressed, heavy but controlled, absorbing pressure without panic. Silver is doing the opposite. It's snapping downward, rebounding weekly, and widening its daily ranges. That divergence isn't cosmetic. In prior cycles, 2008, 2011, it appeared months before the most violent phases began. The metal that moves first is rarely the one institutions are most protective of. Data from late 2024 into mid-2025 shows a clear pattern. Every silver rally attracts heavier selling than the one before it. This isn't profit-taking by scattered traders. It's structured distribution. The volume profile shows sell-side pressure concentrated at predictable price zones, suggesting large players unloading inventory systematically. Meanwhile, official inventory reports show physical silver declining in major vaults even as open interest in paper contracts expands. When the paper market grows while the physical market shrinks, price becomes a narrative rather than a reflection of reality. This is where the timeline starts to accelerate. The paper-to-physical ratio has quietly climbed to levels that historically precede sharp repricing. Charts comparing COMEX open interest to registered inventory reveal a widening gap that hasn't T-closed since early 2023. In previous cycles, once that gap reached extremes, price eventually moved, not upward in celebration, but downward in correction. Reconciliation in leveraged markets is rarely gentle. Institutional behavior adds another layer. Options positioning into late 2025 and early 2026 shows increasing demand for downside protection. This isn't fear from the crowd. It's preparation from entities that model outcomes months ahead. Large traders reduce long exposure while volatility rises, a classic signal that risk is being transferred, not eliminated. When those who move size prepare quietly, it's because they expect turbulence, not stability. History doesn't repeat cleanly, but it rhymes closely enough to ignore at your own peril. In 1980, silver collapsed after leverage concentrated around a small group of players. In 2008, it lost more than half its value as liquidity vanished across markets. In 2011, silver peaked violently and then unraveled while gold held firm. In each case, the warning signs appeared early: expanding volatility, weakening rebounds, and a disconnect between paper pricing and physical constraints. Today's setup carries those same signatures, amplified by automation and speed. The industrial dimension complicates the picture further. Silver's role in solar panels, electronics, and energy infrastructure has grown steadily. On the surface, that suggests support. But industrial demand doesn't behave like investment demand. When financing tightens or growth expectations slip, industrial buyers step back abruptly. Charts from prior slowdowns show that when industrial demand expectations roll over, silver reprices faster than gold because it loses its growth premium while retaining its volatility. Gold can sit, silver can't. Currency dynamics intensify the pressure. As central banks navigate inflation, debt, and political constraints, the dollar's direction becomes erratic. Gold benefits from uncertainty because it's treated as a reserve asset. Silver doesn't enjoy that status. When the dollar strengthens, silver absorbs the hit. When the dollar weakens, silver rallies. But recent rallies are being sold into with precision. That behavior suggests silver is being used as a pressure valve in the system, a place to release stress without destabilizing more protected assets. The timeline moves into a more dangerous phase when volatility stops shocking participants. Silver AS Volatility Index has spent more time elevated over the past year than at any point since the global financial crisis. High volatility doesn't mean the worst is over. It often means the market is loading energy. The longer volatility persists without resolution, the more violent the eventual move tends to be. Retail psychology fills the remaining space. Many participants believe silver can go much lower because of production costs or historical averages. That belief is common before major declines. Markets overshoot, not because fundamentals justify it, but because positioning demands it. Charts don't respect fairness. They resolve imbalance. When too many positions lean the same way, the market clears them out. By late 2025, the signals converge. Weak economic data followed by weak silver rallies becomes more frequent. Strong headlines fail to lift price. Gold remains comparatively stable, reinforcing the divergence. This is the phase where denial is most comfortable, because nothing has collapsed yet. But this is also where timelines harden. Once silver begins printing lower highs against a stable gold backdrop, the probability of a sharp repricing rises sharply. The institutional layer doesn't react to headlines, it reacts to flows. Liquidity studies show thinning depth on the buy side during sell-offs, a sign that bids are being intentionally pulled. When bids disappear, prices don't slide, they fall. Automated systems amplify the move, triggering stops that cascade through leveraged positions. This is how crashes feel sudden, even when they were built slowly. Charts from previous cycles show that the steepest silver declines occur in compressed windows. Weeks, sometimes days. In 2008, much of the damage happened before the broader public realized what was unfolding. In 2011, the drop erased months of gains in a fraction of the time it took to build them. Speed is the defining feature, and today's markets are faster still. As 2026 approaches, external catalysts become increasingly dangerous. An interest rate shock, a liquidity event, or geopolitical stress doesn't need to be catastrophic to trigger movement. In a fragile system, small disturbances create large reactions. When leverage is high and confidence thin, markets don't wait for confirmation. They move first and explain later. The narrative environment shifts late in the timeline. Stories of scarcity and upside give way to explanations of why the decline makes sense. Analysts who dismissed warning signs begin reframing charts after the fact. This isn't hypocrisy, it's adaptation. Markets rewrite stories to fit outcomes. By the time consensus forms, the repricing is usually complete. The consequences extend beyond price. A sharp silver decline would ripple through industrial supply chains, derivatives tied to precious metals, and portfolios overweight speculative exposure. Confidence erosion tends to outlast price declines, keeping markets suppressed longer than fundamentals alone would suggest. Gold, more insulated, may drift or correct modestly. Silver, exposed, absorbs the shock. What makes this timeline particularly unforgiving is its subtlety. There's no single date circled in red, no announcement that declares what's coming. The evidence accumulates quietly. Inventory gaps, volatility behavior, institutional positioning, and psychological cues. Together, they form a sequence that has played out before, always ending the same way. By the time the move accelerates, most participants will experience it as a surprise. But surprises in markets are often just ignored warnings reaching critical mass. The structure of silver, its leverage, its industrial dependence, its speculative participation, makes it uniquely vulnerable in this cycle. Those characteristics don't disappear because they're inconvenient. They express themselves when conditions allow. As the final phase approaches, reaction replaces reasoning. Prices gap, liquidity evaporates, explanations chase outcomes. This is where timelines conclude, not with a gentle adjustment, but with a decisive shift that resets expectations. Silver has never declined politely when pressure builds this way. This isn't a call to action, it's a record of conditions. The timeline is visible to anyone willing to look past noise and into structure. And structure doesn't negotiate, it resolves. When the move finally completes, it won't feel like something new. It will feel like something that had been unfolding quietly for years. And in the aftermath, the most unsettling realization won't be the losses themselves, but how clearly the path toward them had been laid out in advance, step by step, signal by signal, until inevitability was no longer a theory, but a fact.